Now that we've discussed the income statement, let's turn our attention to the balance sheet. The balance sheet essentially lists the assets of the firm as well as the liabilities and shareholders' equity. The assets of the firm are, in a sense, owned by two groups of people. The people that we think of as owning the firm, the equity holders, but before the equity holders claim, the debtors are entitled to be paid. So to the extent we've borrowed money, they get paid first. The items that are listed on the asset side of the balance sheet are stated at their original cost rather than at the current market value. Let's start looking at the balance sheet by looking at the assets. The assets on the balance sheet are listed in order of liquidity, and by liquidity we mean the ease with which the assets can be turned into cash. In fact, if you look at the assets on a balance sheet, the very first asset that's shown usually is cash. Cash doesn't have to be converted into cash at all, it already is cash. After cash, we have a number of other assets listed essentially in terms of liquidity. Current assets are assets that can be converted into cash within the next 12 months. We might have some other assets that we invest for some short period of time in a bank account, for example, marketable securities that are temporary investments of this excess cash. Another current asset is accounts receivable. Accounts receivable are assets that, rather than receiving cash when we've sold an item, when we sell goods, we'll send out a bill and we will collect that bill at a later time. That bill that's outstanding is an account receivable. The account receivable hopefully will be collected in the next few weeks or the next few months, and it's converted to cash at that time. Likewise, inventory. Inventory typically takes a little longer to convert to cash than accounts receivable, particularly if we sell on credit, because the inventory is first sold in exchange for an account receivable, which is then collected and turns into cash at a later time. Another current asset are prepaid expenses. These are expense items that we pay for up front that last over several periods. We'll also include investments here typically in current assets, but they need not be current. These are longer-term commitments of funds that include investments in stocks, in bonds, or in other investments in the company, in other companies. Finally, we get to the assets that are referred to as plant and equipment. These are long-lived assets. They're not very liquid. They're difficult to convert into cash, and the firm generally has no interest in converting them into cash. They're interested in using these assets to run the business for the long term. These plant and equipment items are carried at original cost, less accumulated depreciation. Now, the accumulated depreciation is the sum of all the current and past depreciation that has been expensed. Depreciation expense will show up on the income statement. The income statement expense then moves over to accumulated depreciation, and that accumulated depreciation represents all of the depreciation that's occurred in the past. In the same way that the assets we refer to it as the left-hand side of the balance sheet, in the same way that assets on the left-hand side of the balance sheet are listed in terms of liquidity, the liabilities and shareholders' equity on the right are listed in order of who's entitled to be paid first. So we start out looking at liabilities. The liabilities are we start out with short-term liabilities. These are things like accounts payable, notes payable, and accrued expenses. Accounts payable are things that we owe to vendors. They are the mirror image of accounts receivable. Our vendors have an account receivable. We have an account payable. We owe them money. As we pay them, those liabilities are eliminated, but they're entitled to be paid in a fairly short period of time. Notes payable are really short-term contracts, perhaps with the bank, where we've agreed to borrow money and pay it back over a relatively short period of time. Accrued expenses occur because we may have incurred an expense, but we have not yet paid it. A classic example would be when we get to December 31st each year. If December 31st doesn't fall on a Friday, let's say it fell on a Wednesday, we may have workers who have worked 3 days for us but aren't entitled to be paid until Friday. Their wages are a liability. Those 3 days of wages are a liability to us. They are accrued expenses, and when Friday comes around, we will actually make that payment. After the short-term liabilities are listed on the balance sheet, we have long-term debt. And long-term debt is an element that we typically refer to as being a part of the firm's capital structure, which is the division usually viewed as composed of, the capital structure is composed of the long-term debt as well as equity. For this particular company, we also have multiple classes of stock. Shareholders' equity represents the total contribution and ownership interest of all the stockholders. In most companies, that would just be common stockholders. In this company that we've been using as an example, we have preferred shareholders as well. But stockholders' equity would therefore encompass preferred stock, common stock, capital paid in excess of par, which we'll discuss shortly, as well as retained earnings. Let's look at Kramer Company's balance sheet. Here we have Kramer Company's balance sheet, and in blue we see the assets of the firm. In red we see the liabilities of the firm, and at the bottom of the balance sheet in black we see the stockholders' equity section of the firm. Among the assets, we see that the firm has, and remember, these assets are listed in terms of liquidity, ranked in terms of liquidity. The first and most liquid asset is, of course, cash, $40,000 of cash. The firm has marketable securities of $10,000, so that might be treasury bills or something like that. They can be quickly converted to cash. It has accounts receivable of $220,000, but we don't expect to collect all of that, and our history says that perhaps $20,000 of that won't ever be collectible. So we have an allowance for bad debts of $20,000, which leaves us our expected collections of $20,000 in accounts receivable. We have $180,000 in inventory, $20,000 in prepaid expenses. So our total current assets are $450,000. We also have some other investments, which we don't expect to convert to cash in the near term. We have investments of $50,000. And then finally, we have plant and equipment, which totals, net of depreciation, $500,000, but our original purchase price, we see, was $1,100,000, and we have depreciated not only this year, but in all prior periods, including this year, $600,000 of that, and so our total assets are $1 million. Because the balance sheet has to balance the shareholders' equity, and the shareholders' equity is going to have to come to, or the liabilities in shareholders' equity will have to also come to $1 million, and we see at the very bottom of the screen, down here at the bottom, that in fact it does. So that's this point right here. We have liabilities. The liabilities for this firm are accounts payable of $80,000 to our vendors, notes payable, perhaps to the bank, $100,000, accrued expenses, perhaps these are salaries that haven't been paid as of the end of the year but have been earned by our workers, of $30,000. So our total current liabilities are $210,000. In addition, we have some bonds that are outstanding. Those bonds won't be paid for several years. What we'll owe at that time is $90,000. Gives us total liabilities of $300,000. If our total liabilities are $300,000, we had $1 million in assets, we had liabilities of $300,000. What's left for the shareholders, both preferred and common together, is $700,000, which is, we see down here, total stockholders' equity, which is $700,000. Let's clean that up a little and we'll come back and discuss that. Our stockholders' equity section, as we've mentioned before, we have some preferred shareholders. Those preferred shareholders own $50,000 in preferred stock. There's common stock. There were 100,000 shares, and we have a par value of $1 per share, and this is a relatively arbitrary number, the par value. But we have $1 per share for 100,000 shares. That's $100,000 of common stock. And then we have an item called capital paid in excess of par. Now, although the par value was $1, in fact, when we issued this stock, apparently we received more than $1 from the shareholders at the time we issued the stock. We received not just $100,000 for all of the shares we issued, but in fact $350,000 for the shares that were issued. We have $100,000 in par value, $250,000 in capital in excess of par, so money we received beyond what the par value is. So the aggregate there was $350,000 when it was initially issued. In addition to the capital in excess of par, we have retained earnings. The company over time has earned and retained $100,000. This year, if you remember from our income statement, we earned $100,000, but we only retained $50,000 of that. So our income statement, our balance sheet now has $300,000 of retained earnings. Our total stockholders' equity is therefore the $50,000 that we owe to the preferred shareholders, plus another $650,000, of which some of that is retained earnings, some of it is paid in capital in excess of par. The $650,000 that's owed to our common stockholders, a total stockholders' equity of $700,000. So, a quick review: the assets of the firm are worth $1 million. What's owed to those assets, $300,000 of those assets can be claimed in essence by the creditors. They get paid first, and that leaves $700,000 that the shareholders are entitled to. The $300,000 plus the $700,000 is back to $1 million, the same as the assets of the firm and our balance sheet balances. Before proceeding any further, let's take a moment to discuss the concept of net worth, or more specifically, what we refer to as book value. The net worth or book value of the firm is the shareholders' equity less any amount that's owed to the preferred stockholders. So the shareholders' equity minus the preferred stock component. For our particular firm, the shareholders' equity that we just looked at was $700,000. And the preferred stock was shown on the balance sheet for $50,000. Therefore, the book value of the firm as a whole is currently $650,000. The book value per share, if you recall, there were 100,000 shares outstanding. That's 100,000 shares. So our book value per share is $6.50. Our original sale price for our shares was apparently $3.50 based upon our analysis of the shareholders' equity portion of the balance sheet. So originally we issued $3.50. Since then we've had retained earnings of $3 per share, and the current book value per share is $6.50. The book value is an accounting concept. It's not the only value that is going to be of concern to us. In fact, we tend to be more concerned actually with market value. We saw earlier that our earnings were $1 per share. If the firm has a price-earnings ratio of 15, the market value would be $1 times $15 of price per dollar of earnings. Or the market value would be $15. So while our book value is $6.50, our market value is going to be determined by the market itself, and that could be $6.50, or it could be much more than that. Likewise, it could be much less. So the market value is of greater concern to us than the book value is for most financial market participants, for the financial manager or security analyst, for stockholders. The book value number is going to be of more interest to the accountants. After all, the accountant is charged with coming up with an accurate, among other tasks, coming up with an accurate assessment of what the book value is. Now, in the same way that we had to acknowledge there were limitations in interpreting the income statement, there are also limitations regarding the balance sheet. And the most important limitation really has to do with the fact that the values on the balance sheet are based on original costs for the most part, or historical cost, rather than the current market value. And this is also the reason that book values are going to deviate from market values. In particular, if we have, for example, plant and equipment or other long-lived assets, the price that we paid for them originally may have very little connection to what the current value is. In times of high inflation, that's particularly true. Having said that, in the last 2 decades, there's been very little inflation in the United States, and the FASB ruling on the disclosure of inflation adjustments is no longer in force. That doesn't mean that in the future we won't see significant inflation again. There are likely to be significant differences between market values and book values, and those exist in essence because the balance sheet doesn't reflect current market conditions, but instead it reflects the historical values. And we have to acknowledge that that's certainly a limitation of the information that's provided by the balance sheet. Let's look, for example, at several firms, and we can see the market values as compared to the book values of these firms. In some cases, for example, the first firm here, we see that the market value is much higher than the book value. In fact, the market value is 12.76 times the book value. So this firm is trading at a much higher valuation than the financial statements would infer that the firm is actually worth, that the assets of the firm are actually worth, or the shareholders' interest in those assets is worth. You can contrast that with firms at the lower end of this slide, and you see that their market values are in fact much lower than their book values. So the market doesn't consider the firm worth as much as the accountants would record the value of the firm as being based upon book value numbers. In fact, this firm at the bottom trades for less than 50% of its book value.